welcome to yet another episode of Crystal Ball. Great times for the market, relentless up move, Nifty at 8,000 plus. People have got tired waiting for that correction, and it's proving to be really elusive. Got a big face today on the show, Manish Chokhani, who wears two hats now, one as chairman of TPG Growth India and another as director of Udayan Holdings, is with me. Familiar face for all of you. Manish, great to see you once again.
Nice to see you again.
What's going on? Everybody's been talking about the possibility of a correction. Market's not obliging. Do you think this can continue for a bit longer?
Well, Udayan, what seems to be going on in the world is with zero interest rate policies still continuing. All the money which has got printed seems to have found its way into financial assets instead of the real economy. And what that has done is it's kept all world markets on a complete tear. So last financial year, the US was up 30%. Japan has been up 30%. This year, the economy which is entering a recession, Brazil, is second only to India in terms of stock performance. So clearly there's a dichotomy between the real world and the financial world going on. And until this money doesn't find its way back into the real world, I don't see why this party will end. It's tough to make a case for something to come from the equity side of the markets. I suspect this time the troubles will erupt from the currency and bond side. Because the Fed's balance sheet, as you would know as well, is now levered 80:1. At the start of the crisis, it was 20:1. So, I mean, that's the magnitude of what's going on out there. And clearly, laws of economics currently are suspended. And if we count the discount rate as the force of gravity on which everything is based, there is no force of gravity right now. So, short of that, how do you actually say the market is expensive?
Is there anything in the bond or the forex space which is telling you that trouble is brewing, or are the signs just not there?
In India especially, the signs are really the reverse, because the debt flows into India this year have been larger than the equity flows. So if indeed people were expecting that when the Fed stops its quantitative easing in October, and you'll get turbulence on currency and bond again, I wouldn't have expected to see $15 billion of debt inflows into India. So I think people are betting that while the QE will probably come to an end eventually, the money which was printed is already out there, and rates aren't going up in a hurry. And you should think about it, that if the Fed balance sheet is levered 80:1, a 1% increase in interest rates over 2 or 3 years, what does it do to that balance sheet? If the US debt is now 100% of GDP, what does a 100 basis point increase in interest rates mean to the US economy? So it's not easy that rates will go up in a rush in the world. And at the same time, we seem to have got a second chance, where people expect that India is a country where there will be growth in unit volume terms for the foreseeable 5 or 10 years. The rate cycle in India has actually peaked and will probably be heading down. So unless our currency completely craps out, it's a good place to be.
Do you think the global backdrop will be supportive for through 2015? Because the India story is slowly getting fixed, maybe slowly. But one worries about the possibility of an accident globally which derails us. Do you see that as an event, or do you think it will take longer even if it has to happen down the road?
It's, that's the whole dilemma in the world, that you're investing in a world where the laws of economics are suspended. And I'm reminded of the famous Chuck Prince statement of 2007, where he said, as long as the music is playing, you've got to keep dancing. And we know how that ended. So at some point in the world, there is going to be trouble. And like I said, it's unlikely to come from the equity markets. And it's unlikely to be like 2008, because the nature of markets is that the previous mistake doesn't occur. It's something else. It may well be that we create a blowout like 2000, or indeed a crisis like 1998 in Asia or in Soviet Union, something like that, which then cascades into other markets. Having said that, I can't see any country in the world trying to raise interest rates, letting their currencies go up, and getting to a competitive disadvantage with any other economy. So you saw that happening in the UK, and suddenly the UK governor has sort of stepped back. The US realized their rates were expected to go up, and quantitative easing would lead to US dollar going up, and they seem to have stepped back. So I think until you get the employment problem and revival of investments back in the real world, I think this might go on longer than we are expecting.
But to your specific point on history not repeating itself exactly in the same way, A lot of people are likening this rally to 2003 to 2007.
Right.
Do you think the script plays out like that or differently?
Yeah, it's not, I don't think that's the case, because that was a period where we went up, 40% year on year with low inflation and rates falling. I can't make the case for low inflation in India because we clearly have a big supply side problem in our country. And the more we keep our rates higher, the less likely are going to get supply created in the real world in India. So while the government will have to do the right things in getting the policy infrastructure and all set up to get animal spirits back, the fact is we remain among the most difficult places in the world to do business. And that's not changing in a hurry. Attitudinally also, Indian businessmen are seen as someone who exploits the country rather than someone who's creating assets and jobs and employment. Until that whole attitudinal shift happens, this whole dramatic change that one is expecting here is not happening in a rush.
What are the probabilities that this Goldilocks scenario for India plays out? That next year onwards you do see acceleration in earnings and growth.
Yeah.
You see interest rates starting to come down in 2015 and global liquidity is still fairly supportive.
That's really the bull case, and that's really the heaven one all wishes for. Having seen India score so many self-goals in the past, one is hesitant. And I think it's because there's hesitation amongst people like even me, who are at heart, bullish characters. That's the classic wall of worries that you would want a bull market to climb. So if everything looked rosy in the world, everything looked rosy on Indian macro, and everything looked rosy for, Indian corporates, the market wouldn't be at 8,000 Nifty. We'd already be at 12,000. So I think we'll, climb that. We do need earnings support to come through. The earnings, all the predictions I'm seeing are of 15 to 20% growth depending on who's making the forecast, which means if you say on a trailing basis this market will be trading at 20 times trailing earnings.
Sure.
In a matter of 18 months you should be 50% higher from here. So that obviously is if nothing blows up in the world. The odds are actually before things blow up they actually accelerate. So I don't think one needs to worry about things suddenly going off a plank and going to zero. If anything, I would still use corrections as a chance to get more and more deployed into the market.
How long could this day of reckoning take? Because, this scenario that you pointed out, laws of economics being suspended, you could have spoken about this 2 years back as well.
That's right.
So is it possible or even likely that this plays out another 2-3 years and markets get even fatter before some reckoning happens?
That's the real worry, that the longer you delay the inevitable adjustment that the real world needs, especially in the Western economies, the worse the aftermath will be. So while in the next 2 or 3 years we might make a substantial new high, I shudder to think about what follows after that. Because what seems likely is, and if I'm just taking US as an example because the numbers are a lot more transparent than say Europe or Japan, the reality is that if you have to adjust a leverage of 80:1, or you have to adjust 100% debt to GDP ratio, it doesn't happen, very easily. And so while you've solved a period of pain by inflating asset values, it solved the problem for 10% of America, which owns 80% of the assets. Still 1 in 5 families in the US, live on social security or are jobless. That is severe pain in the best economy in the world. And it is the most self-adjusting, dynamic, innovative economy in the world, no questions about it. But there is period of pain. There are unfunded pension liabilities, there are health care. So off-balance sheet liabilities also in the US are very large. And you don't want the richest person in the world and the smartest economy in the world to really get into trouble. Because we hold $300 billion of treasuries as well in our reserves. So it won't be easy. I don't know when that happens, how that happens. I'm not a qualified economist, but I do think about that, and that is the back of the mind, that this can't be a buy and hold market across the world for the next 10 years.
At this point, a quick break. We are back with Manish Chokhani in a minute after this break on Crystal Ball.